Good afternoon, ladies and gentlemen. The pre-budget run-up in the market has finally begun. This Sunday, February 1st, all of us would be working and trying to find out what the macro balance sheet for FY27 ending March 31st looks like. But what are the expectations? We have a wonderful panel which Sakshi and I will be addressing. Joining us on the show are Vaibhav Sanghavi, CEO of Ask Hedge Solutions, Mihir Vohra, CIO Trust Mutual Fund, and Chirag Mehta, Chief Investment Officer at Quantum AMC. Coming to you, Vaibhav. First off, how does this budget look for the coming year? What are your expectations from Finance Minister Nirmala Sitharaman?
No, of course. I think as everybody has a lot of expectations going into the budget, I think from a market standpoint, it's extremely clear that if we continue on the fiscal prudence path, at the same time, keep on raising resources for constructive expenditure in terms of capex, as well as boost on the consumption side as well. My sense is basically, I think it would be a perfectly, well-balanced budget then. Of course, the bigger question is how to raise resource. And in that, in our view, I think one of the most important aspects is to look for disinvestments, especially on the strategic side. So all in all, while being fiscally prudent, keep on supporting the industry and the consumption and raise the resources by kind of disinvestment measures is what I would probably sum up in a very, very short brief.
Right, let me come to Mihir. Good afternoon to you, Mihir. I want to ask you, is this budget going to be more about protecting the Indian economy from global shocks, or do you think the focus of this budget should continue to be on creating long-term growth for our country?
Good afternoon, Sakshi. The budget, I think, will be, focusing more on the growth aspect. We've already seen the announcement that instead of a fiscal deficit percentage targeting, we are going to start targeting debt to GDP, which is at 56% currently. The glide path to 50% is being made. So clearly, the change in stance of the RBI and the government over the last 9 to 12 months has been to stimulate more growth amongst global uncertainty, because we've had huge shocks in terms of President Trump's erratic tariffs. We've also had shocks in terms of the geopolitical issues. So the focus will be more on growth, I would say. The important thing to observe is to figure out whether the thrust on capital expenditure continues like it has been in the past 5 years, where the private sector slack has been taken by the government, and that's been a huge support to the economy. Last year, of course, we saw consumption boost also by cutting income taxes and GST cuts. So the government is, I think, firing on all cylinders along with the RBI to stimulate growth. But this year, again, we need to see continuity of capex. So that's one of the key data points I'm looking at.
Wonderful.
Mihir, one thing. Last time around, when all of us were doing a panel with Shell and me was in Diwali, and you were here, and you said clearly one thing, that you don't want to see the new year coming again with Trump's tariffs and talks about, again and every day seeing Truth Social posts there. On a scale of 1 to 10, how disappointed are you with, again, the talks around tariffs, even talking about 500% plus tariffs now on various days? How are you looking at it?
Not fun to not have the trade deal happen, but the good thing is that in the meantime, in the last 12 months, we've, I think, signed almost 11 trade deals with most of the relevant countries in the world except the US, the EU FTA being the biggest one. So that, I think, will put a lot of pressure on the US to consummate the deal sooner rather than later. So I think it's a positive development, a good start to the year, I would say.
Right. Let's get Chirag Mehta into the conversation. At Quantum AMC, Chirag, what are your expectations from Finance Minister Nirmala Sitharaman? How does it look when you look at the macro balance sheet? What are the challenges, according to you, that the Finance Minister faces for the coming 12 months and maybe for the next 2 years or so?
So I agree that the expectation is on more on prudence. So I think we should expect that red line not being crossed and maintain that fiscal prudence pathway that we have, because that goes a long way to tell investors overseas that we are worried about what things you are looking from a credibility standpoint. It also messages in terms of the inflation expectations indirectly that we set for ourselves. Are we committed to those or not? So I think fiscal prudence will be maintained, but at the same time that not they don't have elbow room to increase capex significantly, but they'll stick to the capex, and probably the quality of capex can improve going forward, is what we are looking for. So I think right impetus in terms of the growth areas, PLI support, etc. Now we have in terms of the trade agreements been going on. So probably we may look at have a large production of many commodities that we consume, and hence rationalization on the custom duty front will go a long way, along with boosting in or giving incentives like the PLI benefits. I think that would go a long way in terms of benefiting the economy and driving that growth path that we are looking for. So I think we will stick with that fiscal prudence. I think that's important, and at the same time looking at how they can support growth with the right levers and benefiting sectors, and some of the sectors have been severely impacted by the trade tariffs. So supporting those sectors in terms of giving that runway till that trade deal happens, probably that could also go a long way in terms of supporting certain high employment sectors. So we are looking at these levers, not very significantly high expectations, but if they maintain fiscal prudence at the same time support certain growth industries, I think that will be what we are looking for.
Right. Vaibhav, let me come to you. One of the key aspects that we've been addressing over the last 1 year is the constant pulling out of the FII money from the Indian markets. Is there anything that the government could put focus on into the upcoming budget which could bring back the foreign money?
Of course, I think definitely the government can do a lot of stuff, especially on this one, purely because, see, I think let's take things into perspective. And when we look at from, say, 2022 onwards, coupled with when the Fed had started increasing the rates, the capital gains tax started to kind of pinch in some way, purely because when we look at an MSCI India index return for last 15 years perspective, it's delivered close to about 9% return, on a gross basis. Now, when you deduct your capital gains tax, it lands to around 7.5% post-tax, even if you're matching the index. Now, the point is basically that at this point in time, when US 10-year is at about 4.2, 4.3, what is the amount of incremental risk I am taking to generate a return, which is IRR of close to about, say, 7.5%? Now, that's a question one needs to definitely answer, and one needs to have that considerable gap for the amount of risk you are taking for being exposed to an emerging market, something like in India. Lastly, I think what we have also faced the brunt is the AI shift which has happened to China, Korea, and Taiwan. So allocations have not only come to emerging market in a very trickled manner, but there has been a reallocation or probably rebalancing towards these countries. So all in all, to make India more attractive, one needs to have that commitment till 2047 that we need humongous capital for this country to drive consistent growth rates over a longer period of time. Now, if you want that, then the policies has to be very consistent in terms of being competitive from a global market standpoint for an investor. So whatever needs to be done, including your capital gains tax, I think everything should be on table.
Fair point. Let's just discuss this in the terms of the macro balance sheet as well, because taxes are being talked about. Mihir, this question is aimed at you. There is a massive shortfall as far as tax collections are concerned, mainly because of slowing GDP and, of course, the cut in GST rates that we saw somewhere in August. How do you think the finance minister will make sure that her tax kitty remains buoyant, and at the same time the capital expenditure is also taken care of? How will these scales be balanced?
Sure. So I think there is some buffer as far as the RBI dividend is concerned. And as Vaibhav mentioned, there is a scope for more divestments also. So I think the sacrifices made on the GST front and the income tax front can be easily offset by RBI dividend and some more aggressive divestments. So it doesn't seem to be an unsurmountable problem. The other thing to note is that this year, because of very low inflation, the nominal GDP growth has disappointed, well, not disappointed, has been low. Low inflation is a good thing. And typically, we see that corporate top lines and taxes are a function of nominal GDP, not necessarily real GDP. The good thing is that next year inflation is expected to go back to around the normal trend of 3 to 4%. And if we do deliver a 6 to 7% GDP growth rate, then nominal GDP growth will automatically go to close to 11%, which means that the tax collection on a nominal basis will automatically rise by that amount. So to that extent, I think we have enough levers to play around with as far as the fiscal deficit is concerned. And I think the key is to figure out whether the revenue expenditure versus capital expenditure ratio continues to be healthy. So far, the last 5 years have shown that it's been a healthy ratio. Growth in capex has been significantly higher and good capex. If that is maintained, then I think we are home.
Okay. Chirag, let me come to you, and I want to take leaf out of what Vaibhav was answering again and putting the same question to you with regards to the capital markets and the capital gains tax. Will there be a rethink? Is there need for a rethink on the entire aspect there, and how important is it for the markets?
No, I think if you look at it from an investor perspective, who's looking at India, I agree with Weber that they either need to make commensurate returns so that they get compensated on a post-tax basis enough for the risk that they are taking in emerging markets, or else they will have to reduce rates to make it more attractive for these foreign investors investing in India. So I think if you look at most emerging markets, don't have such high capital gains taxes. Most have none. And if you look at the collections from a capital gains perspective from these overseas investors are very, very small as compared to the overall tax budgets that we have. So I don't think it helps significantly to aid tax revenue. At the same time, it kind of inhibits or at least they think twice before investing in India from a comparative perspective as compared to other EMs that they have in choice in terms of investing. So I think either we go to a growth rate that compensates far enough for the post-tax returns they will end up making after paying the tax, or else we lower the tax to make it more attractive for them to look at India more seriously.
Okay. Getting Vaibhav into the conversation, one of the sterling highlights of 2025, Vaibhav, was the fabulous return that we saw in precious metals, both gold and silver. Do you see the government tweaking import duties in the forthcoming budget to stem imports for these? Because, of course, this is a short rupee trade. Nevertheless, it drains very precious foreign exchange at a time when it's sorely and badly needed to sort of buttress the rupee.
I think there is a very tricky balance, in terms of increasing the rate versus illicit kind of important in terms of the gold. Now, the other point we need to also understand is basically, see, gold prices or silver prices are it's a global commodity. And it's a combination of what prices they kind of get traded globally along with our exchange rates as well. Now, in the last year, of course, the appreciation in the prices from a gold perspective was high, but it also got coupled with the depreciating INR as well, which kind of led to a massive spike in terms of the gold prices. So yes, we are seeing some amount of momentum, and also structurally, I think the central banks of both China and India are moving, some of the forex reserves probably into these kind of commodities as well. So I think it may continue till the time we don't see a very, very strong trade deal between China-US or India-US. So the robustness from a gold and a precious metal prices, I think, is there to stay till then.
Okay, Mihir, I want to understand from you when it comes to the kind of changes or the reforms that the government has undertaken over the last 1 year, the focus has been to reform taxes, be direct, indirect. A large part of thinking by doing that was to spur consumption. I want to understand from you, has really consumption picked up in a way that the government would have liked through these steps? Is there still a need to do something to spur consumption? And can capex and the focus on capex alone really pull up consumption, or is there more needs to be done there?
Consumption did pick up in the Diwali season, and if you go at the auto numbers and some of the other numbers, they seem to be holding up quite okay in December also. But I'm not a big fan of stimulating consumption for the sake of it. It has to be backed by ultimately higher manufacturing, higher capex on the private sector side. So the ease of doing business theme or the taxation and all those measures, PLI schemes, etc., that were introduced in various sectors, those need to be continuously rolled out for more and more sectors. And ultimately, the longer term growth can only come with manufacturing happening in India. We've done quite well on the services side, but we've not done so well on the manufacturing side. Excuse me. And that's where the focus has to be. So, it's good that we could maintain consumption by the tax cuts, etc. That was necessary in a bit of a crisis situation because the trade impact and the Trump trade impact was quite sharp. But that's not a sustainable solution. We have to ultimately manufacture in India.
Fair point. Mihir, coming to you, as far as 2026 is concerned, what is the outlook for the market as far as gains are concerned, either on the Nifty or in the broader scheme of things? Are you looking to do better than 2025?
Certainly, because I think the anti-dollar trade is only gaining more momentum. The world is likely to be, awash in liquidity, and that's the way metals are building up. That's a clear signal that the money printing presses in the Western world are going to go over time. And that's the reason why I do believe that all asset classes, including metals and emerging markets, anything which is not dollar should do well. India kind of would have done well even in 25, but because of the geopolitics and the lack of a big AI excitement theme in India, we kind of got sidelined. Of course, we probably also started with record high valuations on the relative scheme of things in the emerging markets. But after 1.5 years of underperformance, I think that premium valuation is gone. Hopefully, the AI theme will not be as sharp as it was last year. And gradually, we should see money coming back from China and other emerging markets to India, because now we have really corrected on valuations. And as long as we deliver our normal 6 to 7% GDP growth rate, I think we will continue to be a attractive investment destination for foreigners. So it does look like we should have formed some kind of a bottom in 2025, and we should be on our track to normal growth going forward.
Chirag, anything that you'd like to add to what Mihir said in terms of the top sectors that will be the core focus in the upcoming budget and even for the entire year?
So yes, I agree with Mihir that whenever we have seen that cycles turn for dollar and dollar weakens, there is flows to emerging markets. So we should see more flows coming to India. And on a valuation standpoint, to premium to EMs or China, we look now much sanguine from a historical perspective as well. So I think this should make Indian market more exciting. And probably if there is enough impetus from the budget, I think we should lead to more robustness in terms of flows that should drive markets going forward, and of course earnings. So from a budget standpoint or overall view on markets, I think one thing that budget can also ensure, because if you look at FDI flows on a gross basis are okay, but on a net basis, they are significantly lower than what we used to have before because of the exits that many of these FDI money has seen over last 1 year. So from that standpoint, I think if there is some impetus that they can give, and one easy lever could be, FDI in say in the banking sector, for example, where banks are struggling with getting enough deposit growth. So there could be external money that can come in form of FDI into the banking sector, which could help further as credit growth picks up. We should see that banks are in a good state to be able to support that growth. I think we are very positive even from a valuation standpoint on the banking sector. We have large allocations in that space. Another sector that was, impacted was the IT sector. So I think IT has seen that brunt over last one and a half year of the AI story play out, which did not benefit the Indian IT, traditional Indian IT companies that we have in India. So I think from that standpoint, given the now we probably get into the implementation phase where there could be business coming, because if you have AI talk to your legacy systems, probably it's going to be the Indian IT companies that are going to do that. So from that standpoint, I think there could be some spurt in Indian IT companies, and if you look at commentaries also of companies, they have been more positive of late. And third is consumption. We think that discretionary consumption overall could be beneficiary of what all things that we have seen in India, from a income tax cuts, GST cuts, interest rate cuts. I think all should manifest into better consumption, but it's not going to be on the staples or the everyday consumption. It's going to be more discretionary as we move up the income curve. I think discretionary consumption should be supported. So I think we like these three sectors more from an overall market standpoint, and I think there could be enough levers in the budget that could support these sectors.
Right. Coming to you, Vaibhav, you run a very well-known long-short fund. What's the status at this point of time? Are you more long than short or more short than long?
See, indeed, I mean, the last month has been pretty tricky one, right, in that sense, because we've seen turbulence, especially from an FPI selling perspective. So, of course, as things stand, we are quite neutralish, from a overall positioning perspective. And in any case, as a philosophy, ahead of any big binary events, we don't take a very active call. We let the event pass by, see the outcome, what's coming about from there, and then decide on to our positioning. So we'll wait for what comes out of the budget and then decisively position our portfolios in that direction.
Mihir, what is the single biggest macro risk that you believe Finance Minister must definitely address in the upcoming budget?
From the market's point of view, we do need to stabilize the rupee, because there is a school of thought that believes that a weaker rupee will help exports and all. But if you look at the historical data, it's not helping. Ultimately, we need to have a relatively stable currency, give confidence to investors, that this is a stable currency, and let the nominal GDP growth rate and all take care of the returns from the market. I think the whole concept of ease of doing business, welcoming FDI through various means, needs to be executed much more. And if that doesn't happen, then we run the risk of continuously being on the sidelines, because last year showed that even China, which was supposed to be untouchable in 2024, nobody was talking about China. There was a lot of skepticism as a hostile environment, but when they demonstrated technology, the DeepSeek movement, progress in AI, money flowed even to China. So we need to really up our game in terms of making ourselves attractive with a stable currency and the latest technology, innovations, etc. And more importantly, make sure that we don't scare off foreign capital.
Okay, fair point. Sticking to you, Mihir. In terms of what you are telling your mid-cap and small-cap fund holders, what's the thought process that's flowing from the CIO desk to these investors who continue to repose faith by their SIPs? How do you see their fortunes changing, if at all, in 2026?
So as far as the small, we don't have a mid-cap fund, but as far as the small-cap fund is concerned, where we are getting consistent flows, our whole pitch is that typically the high-growth stocks and segments, they start off as small stocks, as small caps, and then graduate to become mid-cap and large caps. And the sheer number of ideas in the small-cap space far outnumbers the large and mid-cap stocks. So the scope for stock picking in cool sectors, the emerging sectors, is far more in the small cap space. So that's how we are pitching our fund. For example, when we talk about earnings growth, obviously at the index level, the mid cap index has the best earning growth in the last few quarters and over a longer period of time also. But when we look at our small cap portfolio, when we build it up on a bottom up basis, then the earning growth is far better than the market as well as the large and mid cap segment. So if you do the stock picking right, if you catch the themes right, there is good scope for making absolute and relative returns in the small cap space.
Right. Vaibhav, what about you? How are you looking at the broader market space at this point in time, mid and small caps? Are there enough opportunities for them to finally come back, or will this be a testing year as well for the space?
See, I think for mid cap and small cap to move, one, it still currently trades at a much bigger premium from a large cap perspective. I think, however, if the growth continues within that segment, then probably the valuation kind of justified. But for that, we need to see that consistent growth. In my view, I still feel that bigger comfort still lies in the large cap segment at this point in time. And once we see some amount of stability, when we see uptick in terms of the nominal growth, as what Mir mentioned, then is when you probably look at this segment, and then the returns can be much better than the large cap. But till then, I probably prefer the larger cap universe.
Okay, ladies and gentlemen, there is no end to this discussion, but all this will be either proved right or more right on Sunday, where everybody included in this panel would be working. So it's a working Sunday, ladies and gentlemen, 1st of Feb, where we look forward to Finance Minister Nirmala Sitharaman talking about her expectations and her hopes and effort to make financial year 26-27 better than the one that we are in as of now. With that, ladies and gentlemen, we'll call it a day. Thank you, Vaibhav, Mihir, as also Chirag, and here's wishing you all the best as far as 2026 is concerned in terms of returns and SIPs.
Thank you.
That, ladies and gentlemen, was the pre-budget roundup. More and much more is happening on BT TV. Please stay glued.